and welcome to your Monday Futures Market Outlook for September 16th, 2013. This is Patrick Ceresna. As always, start off with a look at the euro and see how the US dollar is trading. We see that the euro has strengthened overnight based upon the summer's pop, and we've now seen it coming to the top end of the zone. German elections are coming up with several weeks, and then Wednesday we have the FOMC coming out with the release of whether or not they're tapering. So there is room for substantial amounts of volatility. With the fact that this entire pullback here being a retracement, that while there is room for this to reject up along this zone, at the same time we cannot technically rule out one of our measured moves to the upside, which could potentially see a rally up to retest the 137 highs from earlier this year. While we are in the big picture bearish the euro, at this point, if we had any technical breaks above the 134, we certainly would have to give it room for 3 cents to the upside on the interim. Next here, I want to take a look at crude oil, and crude has now tested the 110 area on two very distinct occasions, and each time has rejected off of there. We're sort of at a scenario where there's limited upside for oil, while we have not ruled out the possibility of quick spikes up to 114 or 116 on the upside to finish off a couple measured moves. We do believe there's plenty of room for oil to weaken and retrace back down toward the 100 level or lower. With this morning's breakdown over here on the downside, it may have begun some sort of distribution cycle off of this overhead resistance. While we have yet to see any genuine bearish price action, this makes us sort of in a kind of a transition stage in the way the price behaves. If we want to see right now whether this selling follows through with any deterioration down to about 104 to 102, if we start seeing that kind of price action and then subsequently failed rallies, we would have far more confidence that the oil top is in. Next here, I want to take a look at gold, and gold has had a very substantial throwback off of its short-term highs around that 1420 to 1450 level, but we are now approaching a key level where we feel that if it's going to be a bottom, that the buying opportunity will emerge here, as we could see even a further $20 to $40 weakness down into this 1275 to 1310 zone, and it would be in that zone that if the bulls can dig in and hold supports and create some accumulation on gold, that's where we could see a substantial and material buying opportunity emerge. But because the selling has been quite intense and there has been no reversals yet, we want to caution that you want to probably be a little bit late after seeing the reversal occur than to be rushing to get the absolute best price. But you can accumulate a small portion to feel it out to see whether or not that bottom does hold, but really it is about seeing whether a bottom comes in first. Finally, I want to talk about the S&P 500, and we clearly have had a substantial gap higher rally this morning based upon Summers' resignation or withdrawal from his candidacy to be the next Fed chairman. We've now have a very interesting crossroad, because if the S&P 500 breaks to new highs, then this is no longer going to be a failed rally on a short squeeze, but rather another leg in the market advance. If we have a measured move, we could potentially see even another 20 to 40, 50 S&P points higher, as we could see even 1750 on the upside during a short-term advance. While we don't necessarily want to get excited about something like that, in fact, I think it would be a very dangerous proposition overall for retail investors to be chasing that rally, even though you are swing traders and short-term traders can capitalize on short-term moves. It is likely still to be overall the area where a major high will develop up here, and even if there is short-term spurts higher, it's simply something that only short-term traders should be capitalizing on. That was your Monday Futures Market Outlook. Thank you for joining me.